Welcome to Audio SSLC, your audio medium for easy understanding and revision. To download a copy of this recording, please visit audioSSLC.com. Unit 4, Public Finance and Budget. We learn about the following in this chapter: the meaning of public finance and its importance. Budget, public expenditure and public income. Deficit finance and fiscal deficit. 1. Introduction. Do you know how much income your family gets and from which sources? Each family earns income by working in the agricultural, industrial, or service activities. Usually, an individual earns income in the form of rent, that is, on fixed assets such as land, buildings, etc., wages for working as laborer in various economic sectors, interest for lending money to others or depositing in a bank, or profits for investing in a productive activity. Individuals use this income for their day-to-day requirements or consumption, as well as to earn higher income in the future through investments, that is, saving and investment. However, not all of us earn income sufficient to meet all of our requirements. Therefore, balancing income and expenditure becomes crucial. When we spend more than we earn, we are forced to borrow and incur debt. This management of income, expenditure, and debt of an individual is called as personal finance. In the same manner, the government has to manage its income and expenditure, the study of which is called as public finance. In this chapter, you will study how a government manages its finances. Meaning of public finance. Public finance deals with how a government raises revenues to meet its expenditure. As Dalton says, public finance is, open quotes, concerned with the income and expenditure of public authorities and with the adjustment of one to the other, close quotes. Public finance studies the way in which the government manages its income, expenditure, and loans. Importance of public finance. The government's activities of mobilizing revenue, incurring expenditure, and raising loans are part of its fiscal policy. The objectives of fiscal policy are to achieve economic growth, maintain economic, that is, price stability, and achieve a fair distribution of income. The government usually spends the revenue collected through taxes or the money raised through borrowings for development activities. This increases the growth rate of the economy and benefits everyone. Similarly, by spending more during recession and controlling expenditure during inflation, the government tries to regulate the economic activities. Since all these are part of the annual budget prepared by the government, the study of public finance also helps in analysis and evaluation of budgets. 2. Budget. The government prepares and presents budget every year. In India, the financial year starts from April 1 and ends on 31 March of the subsequent year. Budget for the next financial year is prepared during the current year itself and placed in the Parliament for its approval. Through its budget, the government tries to achieve the objectives of growth, stability, and redistribution. So, what is a budget? The statement of estimated income and expenditure of a year prepared by the government is called budget. The central and state governments prepare their own budgets. Normally, the finance minister presents the central budget in the Lok Sabha in February or March. There will be a detailed discussion on the budget in both the houses of parliament, and the government obtains the approval of both the houses before 31st March. Budgets can be of three types: surplus, deficit, and balanced budgets. If the budget shows excess revenue as compared to expenditure, it is called as surplus budget. If the expenditure is more than the revenue, it is called as deficit budget. If both income and expenditure are equal, it is called as balanced budget. In developing countries like India, the governments normally prepare deficit budget and try to spend more to achieve economic progress. Public expenditure. The expenditure incurred by public authorities like central, state, and local governments to satisfy the collective social wants of the people is known as public expenditure. It is incurred on various activities for the welfare of the people and also for the economic development, especially in developing countries. In the 20th century, the role and scope of the governments has expanded and public expenditure also increased. Public expenditure has to create and maintain conditions conducive to economic development. It has to improve the climate for investment. It should provide incentives to save, invest, and innovate. It should also help in acceleration of economic growth and ensure economic stability. The goals of public expenditure are to 1. Promote faster economic development. 2. Promote industry, trade, and commerce. 3. Promote agricultural and rural development. 4. Promote balanced regional growth. 5. Build socio-economic overheads, example roadways, railways, dams, power, etc. 6. Promote full employment. And 7. Maximize social welfare. Public revenue. Public revenue is the income mobilized by the government for purposes of financing the government's activities. Public revenue may be realized from taxation or from non-tax sources such as revenue from government-owned corporations, public wealth funds, grants, etc. Due to the rising incomes and also due to increasing requirements of the governments, the amount of revenue raised is also increasing. Along with classification of functions, the Constitution has also specified the sources of revenue of the central and state governments. We shall now briefly understand the sources of revenue of the central government. The central government collects its income from various sources. These sources can be classified under two heads as revenue and capital receipts. A. Revenue receipts. The revenue generated by the government through taxes and non-tax sources is called revenue receipts. Revenue receipts comprise revenue from tax and non-tax sources. Tax revenue. Tax is described a compulsory payment by citizens to the government without expecting any direct benefit in return. The central government imposes several types of taxes. Taxes are the major sources of revenue for the government. The government imposes higher rate of taxes on high income group and lower rate of taxes on low income group. The poor are exempted from income tax. Similarly, a higher tax is imposed on luxury goods and services used by the rich and a lower tax on goods and services used by the common people. This is called as progressive taxation. The taxes imposed by the central government are of two types. A. Direct taxes. When the tax is paid by an individual on whom it is levied, it is called direct tax. The burden of this tax is not transferable to others. The important direct taxes are personal income tax, corporate tax, wealth tax, stamp duty, etc. B. Indirect taxes. If the burden of tax imposed by the government is transferable to others, it is called indirect tax. Generally, indirect taxes are imposed on goods and services. For example, the government imposes tax on the manufacturer of goods and services at the time of producing such goods and services. The manufacturer transfers this burden to the trader. The trader transfers this burden to the consumer. This means that if the government imposes tax on the producer, the tax is ultimately paid by the consumer. The main forms of indirect taxes are central excise duty, value-added tax or VAT, import-export taxes and service tax, etc. However, with effect from 1st July 2017, a single goods and service tax called GST has been introduced. Goods and Services Tax (GST). GST is a comprehensive indirect tax on the manufacture, sale, and consumption of goods and services throughout India and has replaced the indirect taxes levied by the central and state governments. GST will be levied and collected at each stage of sale or purchase of goods and services. The introduction of GST is a significant step in the reform of indirect taxation in India. It will mitigate cascading or double taxation and helps in creating a common national market. The simplicity of the tax should lead to easier administration and enforcement. From the consumer point of view, the biggest advantage would be in terms of a reduction in the overall tax burden on goods, the highest rate being 28%. Free movement of goods from one state to another without stopping at state borders for hours of payment of state tax or entry tax. Reduction in paperwork to a large extent, and a higher tax compliance. Non-tax revenue. Apart from taxes, the government gets revenue from other sources. This is called as non-tax revenue. The main types of non-tax revenue are 1. Profit earned by the Reserve Bank of India. 2. Profit generated by the Indian Railways. 3. Revenue generated by the Departments of Post and Telecommunications. 4. Revenue generated by the public sector industries. 5. Revenue generated by the coins and mints. 6. Various types of fees and penalties, etc. B. Capital revenue. Capital revenue refers to those receipts which either create a liability or cause a reduction in the assets of the government. For example, borrowings lead to an increase in the liability for the government. Similarly, receipts from sale of shares of public enterprises leads to reduction in assets of the government. Hence, they are called as capital receipts. The government generates capital revenue through other sources too. It withdraws its investment from its own industries. This is called disinvestment. From time to time, the state governments repay the loans they have taken from the central government. Public debt, that is, loans. The government borrows money from internal and external sources. The loan obtained from citizens of the country, banks, financial institutions, and industries is called as internal debt. The loan obtained from foreign governments, foreign financial institutions, and international financial institutions is called foreign or external debt. The figure below in your book shows the revenue and expenditure of the Government of India as per 2014-15 budget. Activity. Study the above figure in your book and discuss the implications. 4. Deficit financing. As studied earlier, the government first estimates its expenditure and then plans the revenue mobilization. When doing so, it usually plans for more expenditure than revenue. In developing countries, public expenditure is usually higher than the public revenue. This is good for the development of the country. In order to fill any gaps between its income and expenditure, the government raises loans from internal and external sources, etc. Governments resort to various measures to cover up this deficit in expenditure over revenue, usually borrowing from the central bank, that is RBI of the country, or by printing additional currency. Thus, deficit financing is defined as financing the budgetary deficit through loans from RBI and creation of new money. 4 concepts of deficit are used and are calculated as shown below in your book. 1. Physical deficit. The excess of government's expenditure over its revenue receipts and non-debt capital receipts is the physical deficit. It is calculated as fiscal deficit is equal to, in parenthesis, revenue receipts plus non-debt capital receipts, close parenthesis, minus total expenditure. 2. Revenue deficit is excess of total revenue expenditure of the government over its total revenue receipts. It is calculated as revenue deficit is equal to revenue receipt minus revenue expenditure. 3. Primary deficit is defined as fiscal deficit of current year minus interest payments on previous borrowings. It is calculated as primary deficit is equal to fiscal deficit minus interest payment. 4. Budget deficit is the overall gap between revenue and expenditure during a given year. It is calculated as budget deficit is equal to total revenue minus total expenditure. But high amount of deficits are not good for the economy as they create liabilities, and uncontrolled deficit also indicates financial indiscipline on the part of the government. It also increases inflation. That is why, to check such practices of the governments, the Fiscal Responsibility and Budget Management Act, or FRBMA, was passed in 2003. It seeks to instill financial discipline, reduce fiscal deficit, improve macroeconomic management, and the overall management of the public funds by moving towards a balanced budget. The table below in your book gives a concise idea about the budgetary situation, that is, budget at a glance in India as revealed in 2017-18 budget. Exercises. Fill in the blanks. 1. The government manages the public finance through dash policy. 2. When the government's revenue is more than its expenditure, it is called dash budget. 3. The person who presents the central government budget in the Lok Sabha is dash. 4. GST came into effect from dash. Next, answer the following in one sentence each. 1. What is meant by public finance? 2. What do you mean by budget? 3. Give the meaning of deficit budget. 4. What are direct taxes? 5. Write the formula for calculation of fiscal deficit. Next, answer in 5 to 6 sentences each. 1. Explain the reasons for increase in public expenditure. 2. What types of taxes are imposed by the government? 3. What is the per cent expenditure on interest payments in 2017-18 budget? 4. Explain the aspects of non-tax revenue of the central government. 5. What is deficit? Mention the types of deficits. In the activities, 1. Visit a Gram Panchayat or Taluk Panchayat office nearby and collect information about its budget. 2. Watch the presentation of the central and state budgets on TV and discuss them in your class. 3. Collect the reports from newspapers about the presentation of the budgets and display them in your classroom. 4. Prepare the budget of your family.